talk more about the markets, understand the global scenario, the impact on the Indian markets, the volatility that has been there. Let's bring on board Dilip Bhat, a market expert, joining in with us this afternoon. Mr. Bhat, thank you so much for joining in with us on Markets at Noon. And sir, I'm going to just start with the volatility that we've seen coming in the last couple of days, especially since Friday after the SVB banks fall. We've seen yesterday a sharp fall coming in the markets. What should one be actually understanding in terms of the volatility coming in the markets? What are you making of this, and what should the understanding be?
Good afternoon. I think what we are seeing, the backdrop is one of panic, too many moving parts, and very frankly, we are hearing all sorts of opinions from everyone, but very difficult to make out what exactly is happening and how the things are going to settle down. As what I always say, that we are all used to quantitative easing, where notes were being printed across by most of the governments, and a bailout and all those things used to help them to mitigate any of the problems. Now we are exactly in the reverse. There is quantitative tightening, and what we are seeing is the hello.
We can hear you. We are seeing quantitative tightening.
So the quantitative tightening is happening, and I think as a result, what we are seeing is that the high interest rates is really singeing everyone. And how to deal with this new scenario, I'm sure even the policymakers are grappling with it, and it's never ending because we are never operating in that ecosystem. And I'm sure all of us fall in the same category. For last 15, 20 years, we have seen the lower interest rate and notes being printed. Now exactly the opposite. So all these things is going to continue to create problems, continue to create some kind of problems for the countries, for some of the institutions. And I don't think we are seeing the last of it. We possibly will see. The question is not of how much interest rate is US Fed going to increase, but how long is this sticky inflation going to last, and high interest rates are going to continue. So it doesn't matter whether they increase or they don't increase, but if this high interest rates continue and the high inflation continues, I think we possibly will see more of such events happening and blowing up in the face. So I think all that makes for a situation of an uncertainty, and market certainly does not like uncertainty, as we all know. So I think we are all seeing the repercussions. And if you ask what should we do, I think we should trade very cautiously. India may be much better placed. So some of those events may happen, but the intensity may be much less. So I would say that as far as the markets are concerned, we should be cautious. And even if we want to buy, it should be deferred and a kind of an SIP kind of buying in a very, very gradual way. One should look at it rather than rush into buying, looking at the opportunities. And one thing I must also say, that in this entire process, what I'm also trying to say is that the P's are getting reset to a much lower level. We are all used to a very high P's. Because of the quantitative easing, the quantitative tightening will reset and readjust the P's, which is what we are seeing is also gradually going to happen in India.
Right. Got the point, sir. Dilip sir, if we just look at it, do you think it's time to buy, the traditional compounders? There are a lot of stocks for years and years they have compounded. They have also fallen in this correction where P's were always on the higher side. Do you believe that that is something which you would look forward as an investment? The old Asian Paints, Britannia, HUL, Bajaj Finance, any of these names which you like but you do not like the price, you think time has come when people can start to look at those names?
So Pankaj, two things are happening. The indiscriminate rise in the stock prices of a lot of, in the price of a lot of those companies that happened in the past 2 years. Now we are seeing that the focus and the flight is completely towards the known and the quality names. So whatever you're talking about, the compounding and all those are all quality names. So yes, at the times of uncertainty, it's always better to be with the well-known management who have had a good track record. So in that sense, to give some resilience to your portfolio, also to ensure that even the long term, they can give you a gradually good returns, if not the kind of compounders they have been in the past. But yes, I think the flight towards quality names will be more out of fear and trying to protect your portfolio than trying to see for any big returns.
Right. Dilip sir, I know you always invest only in equities, and that is something which you have done for your entire life. But, first time around, are you feeling that, FDs are giving you rates like 9%? A lot of corporate bonds are giving you very, very high rates. A lot of government yield bonds are giving you high rates. You think, seriously, time to think when you get 8-10% on a 3-year compounded basis?
Well, I think it's time to blend your portfolio with some of these instruments, which the one which you have described. I think the bonds, the FDs, I think they also can become a part of your portfolio, because you're also getting some risk-free returns. They're not entirely risk-free, as we all know, but still they're giving a much more comfortable and secured returns as compared to equity. And really speaking, as what I just used the word, market doesn't like uncertainty. And when these kind of uncertainty comes, I'm sure that all of us, as a matter of abundant caution, will shift a part of the portfolio towards this. And yes, one must do it to give a better stability and balance to the portfolio.
Okay, thank you so much, sir, for joining in with us this afternoon on Markets at Noon and giving us your insights on the market. What should we be expecting going forward as well? On that note,